I'm going to be giving you plus EV plays and strategy, and we will go from there. Now, of course, Polymarket is trying to crash. They're trying to not get this information out. Now, what I'm going to show you is something that blends pretty much stock trading with crypto trading. This isn't really going to be a great strategy to run with Polymarket and options. This type of thing that I'm about to show you, I'm just going to exit out of this one, is probably going to more concern trading stocks versus what I'm about to show you. All right. So the strategy is basically betting on companies not beating earnings, but then also buying the stock. So how would this work with two different examples? This is Applied Digital, who had earnings Thursday after hours. Now, for those that don't know, most US companies do earnings either before or after the market closes. Here was a case of after on October 9th. So when the market began trading, it was Friday, October 10th today. Here's what we do. You can see here, we can bet no that Applied Digital will not beat earnings. We would want to bet no about a day before and also buy the stock, as you can see. And if we had done that, obviously we would have lost money here. However, look at this. Yeah, they did beat earnings and they did quite well, and the stock went up 37%. So that's one example. But I want to show you another example where this would have worked well, but in a different way. Let's go look at Neogen. Neogen actually did not beat earnings, but what if we had run the exact same strategy as before by buying the stock and also buying no, they will not beat earnings. Let's say we are a good trader and we got it at 70%, which is probably around where we would get it, hopefully, probably around 70-ish, maybe 75. Let's say 70% here. And we also would have bought the stock. It crashed, as you can see, but the fall actually wasn't as much as it might look. You can see this stock crashed about 10% after earnings. You can see Friday was the day of trading. Thursday was after the day of trading on Thursday. You know, the earnings report was released, as you can see. So this is a strategy that I have noticed does work well. But the hardest question here is, what size do you use in order for a proper ratio between the two? Well, let's work on this together. So imagine that we wanted to buy no, let's say $700 right here, as you can see. That we were essentially saying, I don't think that this stock's going to beat earnings. We put up 700 in capital to make 300. At the same time, how much of this stock would we probably want to buy up here in order to have a proper hedge? Well, let's workshop and say that we had bought, I don't know, 200 shares. If we bought 200, our average price would be 6.7, just about, times 2. So it would be about this much money. Now, the balance that we would have now on 200 shares, to make it a lot easier, I'll just do it this way. 200 times it. Yeah, so we would be down about, we would have bought it about $13.70 would have been our cost basis, and we would be down about $155, as you can see right here. However, we would be up about $300 because they, in fact, did not beat earnings. But here's the thing. If they did beat earnings, we would have lost $700. So how much would we have made if this company did beat earnings? Here's the thing. This company was not forecasted to beat earnings. They really weren't. And because they weren't forecasted to beat earnings, if they did, I would imagine this stock would explode probably a lot higher. So would we have made that money back that we had lost here? Maybe. Maybe. But I think the best way to get a proper ratio is to probably workshop through different things of, if they do beat earnings, how much do I think it's going to go up? Maybe we look at the options market in American equity options. Maybe instead of we do, this many shares, we do 500. So we make 150 or lose 350. Maybe that's a better one. And for this one right here, we could do the same thing, but maybe a bit different, in the sense that Applied Digital was very likely going to beat their earnings. So we probably want to load up a little bit more on no, because it's so cheap. Essentially, we could have gotten it the day before at, you can see this right here, like 10%. So if we had done that with $100, said no, they're not going to beat it, that's an incredible hedge. It's an incredible hedge because if this stock actually did not beat earnings and do this, we would have made 10x our money, right? So the proper size here, it's tough, I'm not going to lie, but maybe here, if we had done, I don't know, 40 shares, made up number, just 40 shares, but let's see what that would have done. Yeah, if we had done 40 shares, would that have beat this? Well, we lose 100 because they did in fact beat earnings, and we're betting no. but how much did we make from this, from buying the day before and then closing out at the market open, right? Because we probably just going to close the market open to minimize any issues. So if we had done it and closed out at open, we would be up $342, okay? And at the same time, we'd be down 100. That's an arbitrage, semi-arbitrage profit of 242. This strategy, I think, can work well. The only tough part is two things. One, what ratio do you want to use? Completely up to you. And the second thing that might be tough is how much do you think that the earnings will be beat by? Beating the earnings by one tick is very different than beating the earnings by a massive margin, you know? So that is another thing you might need to factor in. But the good news about this type of strategy is that it's incredibly easy for you to backtest. It's easy for you to backtest because all previous earnings are just right here. Look, you know, we can click on all of these. We can go to Levi. We can say, hey, you know, what's Levi? Levi Strauss & Co., as you can see right here. If we had bet on no, they will not beat earnings at, let's say, 10%, inverse of 90, you know, how much money would we have made? So if we go here and just type in the stock ticker, you can see that, when did their earnings come out? Their earnings came out October 7th. Okay, so we would have closed out on October 8th probably, or October 7th. So October 7th, yeah, so we would have bet that they were not going to beat earnings at about 10%. At the same time, you can see that the stock did beat earnings and went up a little bit, but because it's such a large company, it didn't go up that much. But the stock did go up October 8th, the day after earnings were released, which is when we would probably sell, but really nothing happened. This would have been a break-even losing trade because there's just no price movement, you know, whatsoever on that one. So maybe smaller companies might be better because higher volatility, but that's really up to you. That's been a bit over 5 minutes for the alpha. I do think playing earnings, buying no, and buying the stock can be an adequate hedge. It's just the ratio and how you really want to manage that risk is probably best. For me, what would I do? I would probably buy no about a day before and then buy the stock at the same time I buy no. I'd want to have that at the same time. Probably on Robinhood because it's just so easy to buy stocks on Robinhood. And then after I do that, I'm going to just sell on market open. And then just go from there and refine the strategy. It hasn't been arbed out yet. Maybe after this video it will be arbed out, but that's the strategy. If you like strategies like this, highly recommend you join our Discord before anything changes because we share so much alpha in that Discord, so definitely worth it. Enjoy your weekend, and when the next week comes and earnings are beginning to come right back, maybe this is a strategy you want to backtest and check out. See you guys.